Now, on Friday, we saw the market come down. It was like 660 some odd points. And everyone is looking at this, saying, wow, look how quickly that dropped. We also see the cryptocurrency market where Bitcoin dropped quite quickly also. Now, the thing is, when the crash hits, when everything starts to fall apart, it's going to come down very, very fast and people aren't going to know what's going on. Yes, it looks great when it's being pushed up. Everyone thinks that it could never end, but all of a sudden, with a snap of a finger, things can change. And this is a warning to everyone that things can change very, very rapidly. Now, this was a very tiny, small drop, but just coming down 660 points, there was 68.5 billion that was lost to the very, very wealthy. And yes, is this a lot of money? No. But what we can see is when the market comes down, and it comes down hard, and those people who aren't in the inside who are shorting the market, they're going to lose a lot of money. Now, a lot of people out there say, well, I don't really care. I'm not in the market. It doesn't affect me. I don't care if it goes up. I don't care if it goes down. But for those people who are working in companies where the stock market reflects how the company is doing and allows the company to continue on the way it is, even though it's illusionary. When the market comes down, it gives corporations an excuse to start laying off people, to shut plants, to shut certain departments down. And this is what corporations use to what they call restructure or to minimize costs and things like that. So even though you're not invested in the stock market, this is a way where it's the end of the economic cycle where the stock market is the flare that is shot up into the sky to let everyone know, because everyone follows the stock market, that the economy has turned down. Even though the economy has turned down way, way before this, it allows the companies the excuse to start laying off people. And even though you're not invested in the market, guess what? You could lose your job. Plants can close. Pensions decline. There's a lot that goes on with this, and this is why they keep the market up to a certain point, and then they're able to drop it at a certain point because they can affect a lot of different areas and allow corporations to restructure, cut their costs because they know it's one gigantic illusion, and even maybe have bailouts, and we've seen this in the past. Now, what's very interesting about all of this is that this is looking very much like 2008. And we have to say, did Friday's market plunge mark the start of the next crash? Economic and market conditions are very, very similar to late 2007, early 2008. Remember back then? Everything was going great. Home prices were soaring. Jobs were plentiful. The great cultural marketing machine was busy proclaiming that the new era of permanent prosperity had dawned thanks to the steady leadership of Alan Greenspan and then Ben Bernanke. And of course, the financial crisis arrived in late 2008, even though prior to 2008, that crash, when it came in October, they were telling us they weren't forecasting a recession, everything is contained, there's no problems, housing does not go down, everything was great. And they were raising the rates all throughout this period of time, and they realized when they hit a certain area, things started to fall apart, so they dropped the rates, and Ben Bernanke dropped interest rates to 1%. This provided an unprecedented incentive for investors, institutions to borrow, igniting a massive housing bubble, as well as an outsized equity and bond gains. They did this on purpose. And this is coming from Chris Martenson from Peak Prosperity, saying that this is very similar to what happened in 2008. Now, it's worth taking a moment to understand the mechanism the Federal Reserve used back then to lower interest rates. It did so by flooding the banking system with enough liquidity, and of course this is done through electronically printed digital currency units, until all the banks felt comfortable lending or borrowing from each other at an average rate of about 1%. The knock-on effect of flooding the U.S. banking system in this way created an echo bubble to replace the one created earlier during an Alan Greenspan tenure known as the dot-com bubble. Now, when we look at this, we can see how they have created their bubbles, because we can see this huge surge and it reaches the top and then everything drops off again. We saw that back in the dot-com era. Then we saw the echo bubble. And here we are where we're twice as high as we were from the other prior two bubbles. And it tells us something is going on here. And we know what's going on here. It's one gigantic illusion. Now, the warning signs in 2007 were abundant and for most completely obvious in hindsight. Again, when you're in 2007, in 2008, you're really not seeing it because, again, you're hearing the corporate media, you're hearing the central bank, and everyone thinks that this is going to continue on forever. And when we look back, we see that, yes, there were many, many signs, and there are many parallel features that we see today to going back to 2007, 2008. Now, in 2007, people were borrowing heavily against their rising home prices. Today, we have record household debt, record auto loan balances, record corporate debt, and a record sovereign bond debt. In 2007, the Fed was carefully raising the rates to see if they could build up an interest rate buffer. Today, we also have rising rates and declining market liquidity due to reduced central bank QE activity. Now, the raising rates today, it's not exactly the same as it was in 2007. Now, unlike the mechanism the Fed used in 2007, today it's not driving interest rates higher by withdrawing liquidity. Instead, it's doing so by simply offering a rate of interest to banks on their excess reserves, and that drags the overall rate of interest up. Why? Because if you're a bank and you have the choice between either lending overnight to another bank or lending money to the Fed, then you're going to take the best deal. Right now, the Fed is offering a pretty darn sweet deal. And we can see this with the chart. We can see that interest rates on excess reserves are moving up. And if we go back to 2016, it was around 0.04, and today in 2018, it's around 1.5. Now, without this little feature, and by the way, this was authorized by Congress back in 2008, the Fed would have to drain many hundreds of billions of dollars from their system to hike interest rates. Instead, now they can just set the interest to banks on their excess reserves higher, as if it were magic dial that sets the price of money. It's a pretty darn cool trick, but its newness prevents us from looking to past interest hiking cycles for clues as to how this current one will play out, because the dynamics are totally different. Now, the Fed is starting to drain liquidity from the system. It's using a process it refers as reducing its balance sheet. On that front, we see that the Fed has allowed some $30 billion of treasuries to roll over on its balance sheets. This simply means that when these instruments mature, the Treasury Department returned the principal to the Fed instead of seeing the Fed replace the bonds by printing out more money to buy more of the same securities at the next Treasury auction. So here we are, 9 years into the recovery, and the central banks printed the largest amount of emergency money ever. So are we still experiencing an emergency of historically unprecedented magnitude, or are we years into enjoying a robust recovery as the corporate media is trying to convince us of, as the Fed is trying to convince us of? Which is it? Well, the markets cannot withstand any reduction in stimulus. If the projected tightening actually occurs, asset prices will begin to fall violently in response. When that occurs, all the central banks' promised plans will be tossed in the trash. The ensuing rescue efforts will unleash a tidal wave of liquidity that will dwarf the efforts of the past decade and very likely destroy the remaining purchase power of the world's major fiat currencies. So to allow the central banks to do all of this, what needs to happen first? Well, the markets need to fall very, very hard. This will allow the central banks enough political air cover to do their drastic action of pushing the interest rates back down, creating more stimulus, because they know that this is not going to work. And we're probably going to see the Dow close between 500 to 1,000 points in a single day, just like today. And we're going to see this happen more often. And once again, this could be the beginning of the economic crisis. And like we said in prior reports, Mnuchin was out there and he was pushing a weaker dollar, which I believe he nudged the world to think that this is the approach the United States has taken, even though there's agreements with other central banks saying that the U.S. would never do this. And I think this was pushed out there on purpose to try to start the avalanche of the system coming down. And here we are today, where we're seeing that things are rapidly changing. Now, I'm not saying that the market's going to come down another 500 to 1,000 points coming up this week. Most likely, it'll probably shoot back up. Because remember, the central banks, they don't push their agenda unless their plan is ready to go. And they need to blame. They need to have the news come out that there are problems in the economy. They need all of this to happen before they start doing it. So what they do in the beginning is they begin their entire process. They push the news out in the corporate media. They push their news about a weaker dollar, and they head down this path. And you'll hear more and more news come out. And of course, we might even see Trump trying to correct what they're trying to do. Because remember, there's a fight of who's going to bring down the economy. Now, on one hand, the central bankers, they don't care about the people. Just like, look at the past. They'll bring it down hard and fast. They don't care how many people are hurt. They don't care how many people lose their wealth, because their idea is profit. Their idea is take the wealth from the people when everything crashes, buy things up on penny on the dollar, and this is what they do. On the other hand, we're looking for a softer transition. We're looking for a softer crash. The economy right now is falling apart. It doesn't matter what the corporate media is saying. It doesn't matter what the Fed is saying. It doesn't matter what anyone is saying, because they said all of this back prior to 2008 when the whole system fell apart. They told us back then that everything was great. Everything's contained. Subprime securities, AAA, no problem with real estate. That doesn't come down. There's no corporations in trouble. And it turned out that everything they told us was a complete lie. Do you really think they're telling us the truth now? Do you really think the corporate media, the Fed, and all these individuals who've lied to us before is all of a sudden telling us the truth? Yes, they make it seem like, well, we had no idea this was happening. Really, the people who are controlling the economy of the entire country, actually of the world, because the U.S. is the reserve currency of the world, they're trying to tell us they didn't even see it coming. They had no idea. Think about this for a second. They know exactly what is happening. They know exactly what's going on. They know exactly which companies are in trouble. They know exactly which banks are in trouble. They know exactly that these subprime securities were complete junk. And yes, these agencies are all intertwined. People are getting paid off. There's corruption. That's why you see all of this. So they've been telling us a lie, making us believe to get us to this point, because they want everyone all in. This is what they did prior. Think about 2008. Everyone was all in to real estate. Everyone was all in to the stock market. The pensions were all in on the subprime securities. Everyone was all in. And guess what happened? They pulled the rug out from everyone, and everything came crashing down. The same thing is happening today. They convinced everyone by creating bubble after bubble after bubble after bubble. This is not by mistake. This is done on purpose. We're heading towards a new system. We're heading towards a collapse. The system is not repaired. It's an illusion. People thought everything was great leading right up to the crash of October of 2008. Everyone thought, wow, this is incredible. Yes, there was a lot of people, I think like 38% of the population got hurt by this. The rest, well, they held on to their jobs. Maybe they didn't get raises. Maybe they didn't get the cost of living raises. Later on, more of the percentage of those individuals that still had their jobs maybe lost their jobs. A lot of people lost their homes. This time around, it's going to be much worse. Why? Because they didn't fix anything. It's based on a lie, on an illusion, just like Enron, just like Bear Stearns, Lehman Brothers, AIG, the automobile manufacturers. None of these companies were doing well. They all should not exist today. They all should be wiped out and gone, broken up. But they're still here. This time around, it's going to be much worse because nobody learned their lesson. Nobody felt the real pain. It was taped over. And it was created to make everyone believe that everything is now fixed. And this is what everyone is believing right now. And it's going to be a complete horror show when the system falls apart. Because everyone, except those people who are realizing what's going on, but the majority of the people don't, they're going to be shocked and surprised when this system comes down, because they're not going to understand Why did this happen? They're telling us that everything's been great. For all these years, they're saying that we're improving. It's great. The market's going up. Why did everything change? Because they didn't understand what was happening. Just like everyone back in 2008 didn't realize what was happening under the covers. They didn't realize the subprime securities weren't AAA. They didn't realize that the automobile manufacturers, the AIG insurance company, all the banks, and everything else was falling apart. That credit froze up. Nobody realized all this. They didn't realize the pension plans invested in all these subprime securities that weren't AAA. They didn't realize all of this was happening. That people were just buying houses with no qualification on their income or, their credit or anything like that. They were just giving loans out to anyone. And people were buying 3, 4, 5 homes. The whole thing was built on illusion. People were taking equity lines of credit out on their house, on their mortgages, to go buy cars and to go buy other